Good morning. Welcome to another episode of the Skytale Insights podcast. I'm Annie Robertson Hockey, president of Skytale, and I'm so thrilled to be here with McConnell Smith, who is partner at VMG Partners, which is a branded consumer growth equity fund. So good morning, McConnell.
Morning. Thanks for having me.
Yeah, of course. Well, so first of all, what's a branded consumer growth equity fund? Maybe we could start just with a little bit of background on, VMG as a whole. Obviously, we have known each other for a while, a few years now. So maybe we could start with background on VMG and then a little bit just on yourself and how you found your way there.
Yeah, no, happy to do it, and thank you again for having me. I'm excited to do it. As you mentioned, we've known each other for a while, and you're my go-to on all things sort of healthcare meets retail meets consumer. So I'm excited to chat. VMG, as you noted in the upfront, we're branded consumer growth equity. We've been around for a little more than 20 years and have raised 6 funds. We're investing out of our 6th fund right now. But the way we define the world and the types of things that we focus on and invest in is predictably, given the name, we invest in brands. We don't do really anything up or down the value chain in consumer. We invest primarily in founder-led businesses, not always the founder running things as day-to-day CEO, though a lot of times that is the case. But I think more importantly is having that founder passion and energy and DNA infused through the organization is a big part of what we look for and a big part of why the brands that we've partnered with have been so successful. And then we've within consumer, we've intentionally been very narrowly focused on a few verticals and 2 business models, and we can go into why we think that's helpful and why that's important for us. But everything we've done has been in food and beverage, personal care and beauty, pet and fitness and wellness, and has either been a consumable product or a multi-site service. And really the common thread between those business models is where can you get repeat engagement with consumers? We have found that the emotional bond that consumers really form with a brand comes from that repeated interaction, from becoming part of their daily or weekly or monthly routine. So those are the things that we get really excited about and have not really deviated from. Outside of that, given our kind of growth orientation, we can be pretty flexible in how we invest. So we'll make minority investments, majority investments, all primary, all secondary, anywhere in between. We really prioritize amazing brands, partnering with incredible people and operators, and then we can get pretty creative in how we structure our investments around that.
Yeah, amazing. You do. I will say, I mean, every time I think about you guys, I'm like, wow, they really have some sexy brands. It's like, Kind Bar, Justin's Peanut Butter, Drunk Elephant, Daily Harvest. You must have some really fun samples in the office.
We definitely do. Our snack cabinet I'll put it up against any other investments. And the good thing is they're healthy snacks generally too. So I think they'll weigh about 10 or 15 pounds more if they weren't.
I mean, you did say fitness and wellness, so it plays into that nicely.
Right, you use Justin's peanut butter cups and they go burn it off for the solid core class. So it works out.
Yeah. I was noticing in your background that you went to Yale, this college that you've heard of, but right after Yale, you actually went straight into L'Oreal, it looks like. So again, most bankers kind of move to New York and do like a generalist thing. How did you know so early on that you wanted to work in consumer, or maybe it was an accident and sort of a happy accident?
And you're giving me too much credit. I wish it were a little bit more intentional. The reality is I was a bit lazy in college and I did a bad job preparing myself. And when I picked my head up kind of midway through my senior year and said, oh, maybe I want to try investment banking, obviously everything had already been snapped up and I had missed the boat. And my time at L'Oreal was actually a very fortunate accident or coincidence. I was actually going to work at a specialty chemicals business based in Cleveland. And about a week before I started, they sold 75% of the company, including the division that I was going to be working for. So I was kind of freaking out. I thought that I was going to graduate, not have a job, be a disappointment to my family, the whole thing. But the woman that I was going to work for at this chemicals business, her husband worked at L'Oreal. And so I was just, excited to get to work, excited to have a job. And so kind of snapped it up. I worked in their sort of prestige hair care division, which if anyone has ever met me or sees this on video, is kind of laughable. But it was fascinating, and it was really my first exposure to consumer and the branded side. And the group that I was working for, I was in their supply chain finance group, had just made a ton of acquisitions, and I was not on the diligence team or anything like that. We were more integrating, and I was very junior, so I was just kind of taking orders, but really gave me a ton of exposure and really cemented for me my excitement and my conviction that I wanted to be around branded consumer M&A for the rest of my career.
Yeah. Well, that is a really lucky break. Chemicals to L'Oreal. I think that was something was looking down on you. I too, for the record, missed the boat on both consulting and banking. As an undergrad, I had to go back to B school to get my way into consulting. I'm pretty sure I thought investment banking stood for international banking until I was like, post college. But here we are. I had my stints at Goldman. We made it. Well, good. Well, we're here today to sort of talk about the state of the consumer industry and, largely like the state of the world and the M&A market, et cetera, et cetera. But before we do, sort of curious, like, how do you keep a pulse on what's happening in the market other than, I'm sure deal flow, like a lot of pitch books are hitting your desk?
Yeah, no, and you kind of noted, and obviously that's a pretty good indicator of just volume activity and enthusiasm and everything like that. One of the benefits of the focus that I mentioned, of the very few verticals that we spend time investing in, one of the benefits of that is we have the luxury to go really deep within those verticals and not have it be sort of a waste of time. And what I mean by that is we can really spend time with retailers and operators and manufacturers and so a tangible example, we spend a lot of time with Target and Walmart and Sprouts to really understand what are they seeing, what brands are they excited about, what trends are they excited about. And so what we try to do is sort of look at the investment side and the deal flow side and really complement that with what we're hearing from operators, what we're hearing from retailers. And that, I think, has ended up giving us a pretty comprehensive picture. We're always going to be somewhat biased by the stage at which we invest and the types of brands that we're investing in. So we try to sort of account for that when we're sort of making our own assessment of kind of the health of the consumer and the health of the economy. But we feel pretty fortunate that we've been able to develop a lot of relationships, not just with imminent investable opportunities.
Yeah. So if you're talking to, say, strategics like a Target, is that because you're trying to keep a good pulse on what they might acquire, like what they're looking to buy or add to their portfolio as a potential exit for your portfolio companies?
Yeah, so certainly with the strategic. So a L'Oreal, for example, we're really trying to understand, and not that is going to, because there's a little bit of kind of push and pull of we're trying to invest in the things ahead of when they're excited about them, but also predict a bit where they're going to be excited. But I think what we have found is that like everyone has their own biases and things like that. So being able to pair L'Oreal's perspective on the consumer and the beauty industry with Target's perspective, with the manufacturers that are supplying our businesses, with the brands that we're thinking about investing in, you're able to kind of triangulate. So if just the strategics are talking about something, then that's probably a little bit less sort of convincing for us than if every one of those, sort of constituents is talking about it as well.
Right. No, that makes a lot of sense. Well, before we get into kind of like, since I assume you have a crystal ball, your predictions for 2026, just like sort of looking back to 2025, like what stands out for you as like main, headlines or themes over the past year?
Yeah. Well, and I'll maybe cheat a little bit and go back even a bit further because I think it provides context to the last year itself. But maybe back half of 23 and 2024 were pretty quiet in terms of, I'd say, fundraising activity. We sold a lot of businesses, and that was not intentional or by design. It just happened to be that a lot of the companies that we had invested in had sort of reached that point. And so we were actually pretty active selling businesses. The last 12 months that was in 2024. the last 12 months or 2025, we were pretty active investing in new businesses, but we found where more of the activity, at least for us, was in the slightly earlier stage, founder-led businesses who were looking to maybe de-risk a little bit, raise a little bit of growth capital, who in 24 maybe were a little bit cautious, thought they weren't going to get fair value, didn't think their process would be fully competitive, and so were maybe a little bit more reluctant to go out. Last year, we saw a little bit more, I'd say, kind of cautious optimism around those things, where people were starting to see opportunities, wanted to invest in growth. Obviously, you had a ton of noise with tariffs and supply chain whiplash and all of these things that were happening, but we felt pretty good that at least for that top tier of brand, there was enough confidence to say, I'm going to go a little bit more on offense. And I think we've started to see some of that momentum continue into 2026, just based on, again, volume of opportunities that we're seeing. It still varies by category and segment, and you know, there's a lot of nuance to it, but at least as a general reaction, I'd say that's a pretty fair assessment of what we saw last year.
Yeah. Do you feel like many of your company, I mean, how much of your focus and your company's focus was on, you know, sort of redoing their manufacturing setting? Like, were you bringing stuff over here? Were you just absorbing the fees, passing it on to the customer? I'm sure there's sort of a mix, but curious, your like general take.
Yeah, well, it was really all over the place. I would say what made it hard, and obviously this wasn't just for our portfolio, was there were so many changes. And so honestly, a lot of the guidance, unless it was, to us, the China exposure feels a little bit more permanent in the sort of more geopolitical tension between those countries. And so as a general rule, I think we've given a lot of our companies guidance that even if you're going to manufacture there, make sure you're getting secondary, tertiary supply elsewhere. And that's important. More, again, less from a cost optimization standpoint and kind of tariff offset, more just for a medium to long-term stability. Yeah. The other, you know, sort of 150 countries that got slapped with tariffs, or however many it was, we tried to kind of give a lot of our companies advice to not be overly reactive, just knowing that there was probably going to be some, you know, some offset or some change. And so that's generally what our companies did. I would say a lot of our companies that we invest in are a bit more at the premium end, hopefully have enough brand strength where we can price up if we need to, you know, sort of take margin. I think in our food businesses, they generally have less international exposure anyway, except for on like the packaging side. And so less of your cost base is a little bit more exposed. And then in things like beauty and supplements, you're high enough margin that it can be annoying, but you're probably still going to be able to run a sustainable business. And so our general guidance was, don't be overly reactive, but prepare a bunch of different scenarios just in case certain things become more permanent or escalate relative to kind of today.
Yeah. Which is like, you know, I mean, candidly, de-risking is probably a good, you know, as you scale, it's like probably a good thing to do anyways.
Yes. Yeah. I think what we saw with some of it's absolutely the right point that some of this was probably like forced diversification anyway, that our company should be doing. What we saw with some of the domestic conversations, at least, was, yeah, you're avoiding tariffs, but because it takes time for supply to catch up to whatever the kind of cost structure changes are, and everyone was doing it at the same time, that it didn't actually end up being that margin accretive to actually kind of pull it. And again, these are general rules, not universal. I think over the next couple of years, as more supply comes online, as there is more investment in domestic manufacturing, some of those things may change. But it wasn't the case that it was, you know, sort of, and I would say also for a lot of our brands, because they're growing so quickly, we want to expand margins and become more profitable, but cost optimization is not necessarily the primary, you know, sort of need for a lot of our businesses. It's securing supply, ensuring quality, maintaining consistency, and then you're probably getting to cost optimization as sort of a fourth priority. And so that also, I think, influenced kind of our sort of reaction to things.
Yeah. So there's that growth in growth equity, rather than, you can sort of focus on like optimization when you're in more classic PE, or sort of like the next buyer potentially as well.
Exactly.
I mean, how do you think the market, just like sort of overall the tone of the market, like how do you feel like the market is doing as we enter this new year?
Yeah, like it feels like there's decent optimism and activity, and again, it's a little bit, can be a bit sector specific, but our last 4 deals that we've closed have been in, I think, 4 different verticals for us, and so it's actually been pretty consistent across each of the segments that we're investing in. It feels like a lot of when you talk to other investors and bankers and things like that, a lot of the enthusiasm around this year is tied to specific opportunities that they're working on or looking at, as opposed to rewind about a year ago and there was some enthusiasm, but it was more conceptual and theoretical. And so I think that is good. I think that there have been some really positive outcomes in the fitness space, for example, that have given others a lot of conviction to say, okay, great, there's and all of it has kind of downstream effects, from the strategics to the larger funds to the mid-cap funds to the growth funds. Everyone wants to feel like there's an opportunity for me to exit this business. And so when Leonard Green buys Crunch, that, opens up a lot of people's sort of excitement that, hey, if I invest at a $300 million valuation, there is going to be a market for me on kind of the back end if I execute. So that, I think, has a couple of those initial dominoes falling, I think, has gotten the ball rolling on some of these opportunities.
Yeah, and I mean, that it's sort of another example in that space is, I think, was it Elle Catterton that bought Solid Core from you?
Yes. Yeah.
Okay,
Yeah.
Nice. Anyone who knows me well knows that I am a large consumer of Pilates, so that's a particularly fun one for me to see. Obviously, sort of going back to like the market and market sentiment, there's obviously a lot of talk right now on the increased cost of living and whether that's passed down to consumers or not. How do you think the average consumer is actually feeling?
Yeah, it's a good question. Again, I'll preface my answer with we're biased a bit by the types of brand. A lot of our brands are catering to a slightly more affluent consumer, and so gas.
I mean, pet is one of your categories, so
and beauty. Yeah. I think like that consumer tends to look at gas prices going up by 50 cents and maybe they're going to complain about it, but it probably won't fundamentally change their spending habits, their behaviors, and things like that. And so that, on some level, has insulated some of our brands. And we try to invest in brands where, like, we kind of think about it as like these new modern consumer staples. So fitness, I think, historically has been viewed as a much more discretionary category. I think if you look at the mindset of today's consumer toward the fitness category, that has shifted pretty dramatically, where it's not just this nice to have, aesthetics driven, it's much more comprehensive wellness. And actually, if you kind of think about, like, there's obviously an aesthetic element to the medical aesthetic space. But if you actually talk to and tease out through consumer sort of work, a lot of why people are doing this, there's a bit more that is truly more of a staple than kind of a discretionary category. So we try to invest in those opportunities, which I think does protect you from some of these shocks.
Yeah,
I think
it is. Oh, go ahead.
Oh, I was just gonna say, I think in the mid tier of consumer, it's interesting because a lot of those models have been pressured even prior to some of these economic challenges. So again, using the fitness space as an example, like 24-hour fitness, Gold's Gym, some of these models, like, they were getting smoked by Planet Fitness well before you had this massive spike in inflation and these changes in cost of living dynamics. So it's certainly exacerbated by those dynamics, but I think there are some competitive elements that are really pressuring a lot of those businesses in the middle as well. And then on more of the value side of those brands, I think you certainly lose some spend on kind of the lower end when there is this pressure, but we've seen a lot of those models actually pick up a lot of that mid-tier volume from people shifting down, looking to save. So as a general rule across most of our categories, we've really tried to stay on the premium side or more on the value side. And we're certainly not alone in that approach, but that has generally served us well.
Yeah, yeah. I mean, one of the things I'm asked a lot, especially from buyers like yourself, or maybe looking at assets, is like, what is discretionary? And discretionary, the definition of discretionary, and I think sort of like recurring, right, has really shifted. And like this new, the sort of rising generation, I think we're seeing that they're much more willing to pay cash out of pocket for things that historically would have been in sort of an insurance realm. So like we're willing to pay out of pocket for concierge-ish healthcare or functional wellness, or to your point, fitness has become, I think, sort of like, tier one. It's like getting your checkup is going to doing your regular exercise. I mean, same as aesthetics, which is something I know you and I have talked a little bit about, just given your investment in Omni.
Totally. No, and that's a really great point. I think the medical side, and I think it is part like people are willing to make the investments because they see the benefits. I think some of it is this distrust of the traditional medical system, complexity, and weeding through all of that, just sort of opaque morass of regulations and reimbursements and coverage denials and things like that. I think a lot of people are saying, I'm willing to pay a little bit of that premium because I'm going to get better care and better outcomes, and it's not gonna frustrate me.
Yeah, and I think there's obviously sort of a betting on general sort of a quality of health too, where younger folks might be more willing to sort of forego that system because they assume that worse outcomes are waiting for them maybe later on in their life. How are you? I mean, are you seeing any? I'd say like I invest the Skytale investment banking firm, and one of the things that we see is deals are just taking a little bit longer. Like there's just more scrutiny and more time spent on quality of earnings, a little bit more time spent on diligence. Do you see that play out in consumer too? Obviously for Skytale it's consumer, but also largely healthcare.
Yeah, no, we absolutely are seeing that. There's still the examples of clean business, super competitive process, goes really quickly. So there certainly are those types of opportunities. But if it's not in that, top 1%, 2% type business and process, then it can take longer. We don't invest with as much leverage up front, so we're a little bit insulated from some of the credit market dynamics, but you can see, especially with what you're seeing right now in sort of the direct lending space and some of the pressure that those firms are kind of facing, like that can be a tricky piece. I mean, that was something that, not to get too in the weeds on the Salcor process, but like that was one where competitive process, business was performing really, really well. And honestly, a bit more of the delay or what prolonged the process slightly was, some kind of lender sort of conversations that happened pretty last minute. So it can come from all these different places. So I think we're telling our businesses going in to now, like when I joined VMG more than 10 years ago, a lot of our brands, we'd go out and we would intentionally be pretty targeted in our processes and say, hey, there's these 6 strategics that have expressed interest. And so if you're not on that list, like we don't need to waste anyone's time. Now, I think both because we've seen a lot of premium valuations come from financial sponsors, but also because you don't know exactly where some wrench might be thrown into someone's process. We probably broadened our processes pretty meaningfully to try to ensure that we're not as subject to some of those kind of process hiccups.
Yeah. What was, just because I'm always curious, what was a recent investment that you feel like just sort of like flew through diligence for you all and to close?
Recent one, when we were investing.
Yeah.
So we invested in a protein bar business called Stars and Honey earlier this year. And that was one that was pretty straightforward. We got that one done in about 45 days from kind of sort of starting to have conversations to closing. What helped there was it's a pretty simple business. It's 8 SKUs and was almost entirely D2C when we invested, and so that obviously helps, right? When it's pretty clean and pretty straightforward. The founder and team there are really on top of their just know the business really well organized, ton of really good, clear, quality data. And so that obviously helps. I mean, from your side of things, when we ask a question and you gotta go, spend a week kind of turning the answer, like that can also gum things up.
And then you get the data and you're sort of it's like stitch, piece it all together. We spend a lot of time.
There's
We
like
spend a lot of time
data
doing
sources, and you're
that.
trying to find some way to kind of tie it all
Yeah,
together.
yeah.
And we're used to that. Like, again, we're investing at that growth stage, so we are not, I'd say it's more typical probably to get sort of some of the messiness and we're having to roll up our sleeves. So we're totally comfortable with it. But it's always nice when you get the founder spent time in PE. So he's like, he came into it with like, all right, I know what these.
Oh, that is very nice. He knew exactly what he's doing. So turning to sort of life post close, you've acquired the Stars and Honey, et cetera. I always try to find corollaries in other industries that we work in. And, I'm one of the things that we hear in healthcare a lot, and I am actually going to a large healthcare conference tomorrow in Miami. And I anticipate there being a lot of conversations around just like this focus on operational discipline in terms of value creation rather than sort of like growth at all costs, if you will. Given you're still a growth equity, like sort of an earlier stage company, are you seeing that kind of focus at all? Like how are you seeing that play out?
Yes. Yeah, absolutely. Like the conversations that we have with founders around margin and margin discipline and not just sort of pace of growth, but the quality of the growth, the composition of the growth has definitely improved. And I think that is good. There still is, as you mentioned, we're growth investors, so we still need our businesses to grow. But I think there's more awareness of the importance of it. We have spent more time on our side thinking about resources that we can provide to our companies to help sort of optimize margins. Like I said earlier, like it's not necessarily going to be the top priority, but if we're able to come in and really provide support beyond just, hey, we did some benchmarking and you're 10 points light on gross margin, so go find, half of those to close the gap, but can actually come in with folks that we've worked with who have done that before. That's a real advantage. It's both a real advantage for trying to win those deals and convince founders that we're the right funds to partner with, but also to be able to capture some of that and not just bank on, hey, we're going to get credit for this when we do our QOV and show the pro forma adjustments. Because back to your point on kind of increased scrutiny around processes, right? If you're able to show at least some progress toward that 10-point margin improvement plan, you're going to get a lot more credit for it than if it's purely theoretically, even if intuitively it makes all the sense in the world.
Yeah. We like sustainable growth over here. How do you see AI playing into that? Like, I feel like there's, even with my firm, there's sort of an expectation of like, we should be able to grow maintaining slightly better margins, especially, let's be honest, on the labor side, just given these new tools. Like, to what extent, I guess, how much is AI part of the conversation right now, even when you're looking at, a potential deal, like, oh, if we use AI, we can optimize here, that's immediate value accretion. So I'm curious there.
It's honestly a mixed bag, and candidly, like, we need to be better at that. I think at VMG, there's obviously a spectrum of companies and kind of their sort of level of adoption of AI. I think on one end, you have some of the companies who are just like, not going to do it. This needs a human touch. I don't want AI talking to my consumers because it's going to be a bad experience. Like, stay away from it. And then on the other extreme end, you've got some businesses that we're starting to see where it's a guy, a couple people remote internationally, and a bunch of AI agents that he's built that is growing the business. And so I think we've had to get smarter on how do you evaluate those types of businesses where it is just a guy and a bunch of technology, and how sustainable is that? And at what point does that start to break, or if it will at all? And then on the other end, like, I don't think that stick your head in the sand, sort of avoid it and still just continue to invest in people is kind of the right approach. I think where some of our companies that have been the best users or the most effective users of it is they've almost stood up internal teams that are kind of like independent, but like where it hasn't worked for a lot of our companies is where every single functional sort of leader is asking for a bunch of disparate tools, and the marketing team wants this and the ops team wants this, and the finance team wants this. That can get kind of convoluted. Where we've seen it best executed is someone has almost hired a head of AI transformation, or pick your title, to look at the organization and say, here's where we want to use it. Here's where it fits best in with our processes. Here's where there's the most rote, duplicative, kind of manual tasks taking place that we can kind of take out. Or here's where the commercial opportunity is greatest. But it's been good to have that as sort of a dedicated function, because again, then they can look at the entire organization as opposed to being a little bit more myopic. I think we've also, seen that like things are, and I won't claim to be any kind of AI expert, certainly far from it, but like things are changing and evolving so quickly. So having someone who is trying to keep an eye out for what's coming, what's changing, who's doing this well, can really help, because obviously your CMO is going to be heads down actually executing the day-to-day, and so you can miss a little bit of what's coming.
That's really interesting. So it's almost like, rather than expecting, say, your marketing leader to adopt some sort of AI capability, the onus is on sort of like an AI generalist, if you will, who can work across categories or teams within the organization and bring in the latest and greatest, and sort of like understand, there's now almost like, like an IA operating layer that will like have to coordinate different, because I think there's this proliferation right now of point solutions, but like at a certain point, what's the layer, the connectivity between all of those point solutions, so that there's actually sort of a cohesive conversation. That's really interesting. I wonder what the background is, or is that like a type of capability that you say, going back to the point of, we as a firm feel like we are needing to and trying to provide more resources to our portcos. Is that something that you're thinking of building out at VMG so you can bring that to, or at least advise your companies on?
We've talked about it, at least where we've landed for now on that role specifically is you still got to know, like, we're not looking for someone who's like an AI expert or a data scientist. It tends to be a bit more of like a consultant or a like project manager almost, who can kind of like sort of understand the business. But the piece where it's hard to do from the VMG level is to do it really well. I think you need to be pretty immersed in the business. And we're pretty involved with our companies. I'd say we're on the further end of kind of the spectrum in terms of like time we spend with our companies. But we're never going to know the business at that detailed enough level, I think, to really effectively drive that. So we've liked having it sort of at the company as a full-time employee for that role. Where we've gotten a bit more, I'd say, leverage or kind of results out of the VMG resources is, as I mentioned earlier, like we only invest in 2 business models. So someone who has been a COO, CFO at a CPG business can bring a lot of value on gross margin improvement, manufacturing efficiency, those types of things. And then for our multi-unit businesses, that similar role, like CFO, COO, who can really help with labor optimization, scheduling, some of those things that are the bigger cost drivers that are similar enough across all of our businesses within a given business model.
Yeah. What's your favorite AI tool that you're using right now?
Like I said, we're pretty pretty behind the curve. It took us like 9 months to get ChatGPT approved. So we started with the basics of just kind of like ChatGPT and Claude, and again, some of the stuff is I think we've seen that like the bigger barrier is not necessarily the tool. It's just like sort of
humans use it
and like committing yourself to like, I'm going to try this and I'm going to do it. But so far, our work also is that like, if we can get a little bit more efficiency on tracking down founders' emails and things like that, like there still is a human element to sourcing at the types of deals that we work on, that, as long as you're getting your foot in the door and get that initial conversation rolling, then a lot of it ends up being still pretty non-AI from there.
Yeah, no, totally. I think it's a transaction, especially when you're dealing with founder owners. That is so emotional. I mean, it's like truly, I feel like, advisory services, consulting, banking, investing in some ways, I think they're becoming more and more human because the sort of technical piece gets stripped out. Like it's easier to set up a data room, sure. Consulting, it's like, it's easy to do a market analysis, sure. But it's the part where it's like communicating, convincing people to change behavior. Like that's the piece that will always be sort of like the fun. For me, this is the fun part.
Totally. No, who do you want to work with for 5+ years?
Yeah.
And I also think like the other thing that we have seen, because we only invest in brands, this is another argument for more the human element, is there's an appreciation for like the easy math when you're looking at a brand is you're spending 10% of sales on marketing and these other brands are spending 8%. And so you just save 2 points of margin. But because it's a brand like that decision on where to invest, where the P&L trade-off to the consumer experience and how they interact with the brands on sort of that human level, is like, that's something that takes time and there is nuance to it. And I think that is something that we have found really helpful in only investing in brands, is there is a bit of an appreciation, sometimes to a fault, for those types of investments that, drag the P&L if you're just looking at kind of the numbers, but end up being really, really good investments for the brand over the long term.
Yeah. I mean, brand is an intangible, right? Like, in many ways, it's like, what's the difference between, again, I'm sort of looking at your page, like, what's the difference between this raw dog food and another raw dog food? Like, there's the core, the quality needs to be there, the ingredients need to be there, but really it's like, at the end of the day, it's something between the human and the brand that's allowing them to pay a premium for whatever that may be,
Totally.
Well, great. Pausing, I think, all of that in mind, this is the part, McConnell, where you get to take out your crystal ball. As we look into 2026, like, what themes or headlines are you seeing surface, and what do you think is really going to be sort of a focus area overall?
Yeah. Again, try to shy away from any kind of macro predictions. I think I got a D in macroeconomics in school, so I'm not
more of
the
a
right
micro.
person
I'm
for
more
that
of a
type
micro
of
myself.
stuff. I will say we are very bullish based on both what we're seeing in our portfolio, the operators that we're talking to, the founders we're talking to, what we're seeing in the categories that we invest in, that this sort of broader health and wellness, defined very broadly in consumer, will persist. That the things people are doing to take care of their physical health, their mental health, their sleep, their recovery, their beauty habits, like all of those things are very, very much durable. I think you see it, as we talked about, like, I think these things are increasingly shifting to essentials for consumers, away from these nice to have, aesthetic driven, episodic kind of brands, to things that are much more permanent, that they're willing to pay more for. We're very, very bullish on that. And I think we have seen too that, because there is a little bit of, especially as you move to the, say, larger, more generalist funds, there's a little bit of caution around consumer. Like, some funds have just kind of, stopped investing in consumer entirely. And I think some of that is pretty misguided if you go beyond just some of the, kind of Wall Street Journal, New York Times headlines, and actually look at what is happening with the brands and the businesses themselves. So we're very bullish on that. If you believe in some of the headwinds, and some of the headwinds are very much real, it should make the growth you're seeing in these categories and with these businesses even more impressive in context, because they're doing it in the face of kind of a challenging environment. So we're super excited. We have continued to be active investing in these spaces. I anticipate that we'll continue to do so over the course of the year.
Yeah. I mean, I actually think it's really exciting because, as you sort of get further and further along into classic private equity, many firms, PE, that were just focused on healthcare, I think they're opening their doors to more consumer types of acquisitions, just because it's a blurred line now. And again, I think there's a lot more confidence and we're seeing it now in this past year, there's a lot more confidence in the durability of, say, out of pocket, sort of more discretionary health. And there, we're almost seeing this evolution of like, if the sort of outside physical health, that's medical aesthetics. Everyone looked at the Zoom and COVID and were like, oh my gosh, there's wrinkles and freckles. Let's fix that. Okay, great. There's sort of now this iteration of internal health. The two go hand in hand, of course. Anything, I think like the cool kid on the block right now is gut health, or maybe that's been microbiome, maybe that's been around for a while. I just did my gut health test, and I did not get an A+, and I'm pretty upset about it.
Hopefully it's better than my macro grade at least.
Yeah, I'm like, and then, I think like the sort of new iterations that we're seeing too is like how the intersection then of your physical health and your mental health. So, guts have serotonin. Guess what? That has huge implications for your mental acuity, your cognition, also your mental health. So now we're sort of seeing even this new ways of like cognitive mental health in the way in which that is actually also tied to like your physical body in the way in which you see yourself in the mirror. So like they all really do talk to each other.
Yeah. No, it's such a great point, because again, like I think you look back 5 or 10 years and each of those pillars of wellness, I think a lot of people sort of engaged with them a bit more in a silo, but the awareness of how those things interact, the importance of, getting good sleep with how you work out with, how you recover, all of those things. Like, I think there's more data to validate sort of the linkage between them. And there are more businesses that are sort of enabling people to understand that. I also think you kind of mentioned the healthcare funds, looking at things that are a bit more, because they're like, that is an area that I think to us is increasingly exciting. And I think you're starting to see more of those brands also figure out the business model, because like dental, for example, right? Like you had a lot of the non-branded stuff, and that's been a super heavily, you know that better than I do, but like that's been a super heavily invested segment. You saw this wave of kind of de novo, highly branded models come out. And a lot of them nailed the consumer experience, but really, really did not on the business model side. I think you're starting to see more people be able to sort of pair the two. Really great brand, totally. Awesome business model. The med spa space, as you know well, like I think you're seeing a number of players really figure that out as well. Yeah. And that to us gets really, really exciting, because you lay on the trends that we talked about of people kind of shifting a bit away from the traditional healthcare system because of cost, frustration, whatever the drivers might be. But I think that opens up another world of kind of models where you can apply this branded lens, but still deliver really effective science-backed care. And that piece gets pretty exciting for us.
That's such a good point that I hadn't thought about. I think like every few years, venture decides it's going to dance in like four-wall healthcare again. And to your point, I feel like there's always been this reckoning between, say a large fertility roll-up and say a Kindbody. And unfortunately, brand doesn't fix margins. Like brand doesn't ensure quality care, because guess what? Like fertility's medicine, and that is something that people take really seriously. But if you can bring the same discipline and expertise and then layer a brand on top of it, that is particularly exciting. And I am seeing like right now, even, Everbody, for example, was purchased by a private equity fund that owns many, many other med spas, and they know how to run a med spa. And so like, I think that's a really good example of if you can marry those two things. And, I know that team, I think things are going incredibly well for them as of now. If you can marry those two things, it's actually really exciting.
Yeah. And I think there's some kinds of care where it's like maybe not quite really, I don't know that going and doing branded oncology clinics is like the right thing. Like there are certain aspects of healthcare that I think you still want that more medical side, or the hormone therapy space, right? You've seen this emergence of male hormone therapy. And I actually think that lends itself incredibly well to branded, maybe a bit outside sort of the traditional, because it's simpler. You're talking about one, it's testosterone, and it's not as complicated as some of the others, whereas the women's hormone therapy space, I think, has remained a bit more true and traditional medical because it is more complicated. There is a bit more, I'm going for a trusted provider, maybe more than a trusted brand. So I think there's nuance to it, but I do think that there are a number of spaces where you can apply some of these more consumer oriented, kind of business model changes to, and I think consumers are open to it.
Yeah. I mean, we have to get to the place where instead of like, am I going to a trusted brand versus a trusted provider? Like the brand signals a trusted provider. So like Kaiser, for example, I think like if you're in the Kaiser umbrella, you assume that those providers have been vetted, trained, et cetera, et cetera. So, I imagine folks are a lot less focused on like, I'm going to, Dr. Susan, and more I'm going to a doctor within this network. That would be obviously like the most extreme version of that.
Right.
All right. Well, thank you for looking ahead with me. As we, just to wrap up, I always like to, ask a few rapid fire questions. What is one product that you invested in that you are a very heavy consumer?
Ghost, easily. I drink like 6.
What's Ghost?
Yeah, it's an energy drink. I drink like 6 of them a day.
I'm
actually, I don't know if I'm drinking one right now. So
I thought Ghost was going to be like a sneaker website. I'm like so out of it. Did you invest in Liquid Death? Was that
no, we did not.
No, you didn't. Okay.
Yeah.
Never mind. Back to Ghost. And then sort of just going back to you and your job, starting out, what's the hardest part of your job?
Hardest part of my job, I would probably say like picking the stuff to really focus on. Like you can, I think, because there's so many interesting brands, there's all these really incredible people, and like, especially in my role, I do a lot of our multi-unit investing. Like it's a pretty broad universe. So really figuring out which one of these do I think is really special. And I would say like the average time from meeting a founder to us investing is like 2.5 to 3 years. And so when you're making those decisions on really where to invest that time up front, that can be something that, could be a multi-year payoff or a multi-year shoot. I, really should have looked at that one. And a lot of times, we're investing in the business that's got success in 2 or 3 markets, and you're making this bet that, hey, this is the one that's going to be able to expand nationally. And so you're not going off of perfect information. So I'd say that one, again, especially because of like the time commitment and sort of the opportunity cost.
Yeah, totally. Flipping to, what's your favorite part of your job?
Favorite part of my job. I would say my favorite part of my job generally is the founders that we get to work with. Like they're so different, have such incredible backgrounds. They're just the courage it takes to kind of just like take on some of these massive incumbents in their categories is really impressive. And then when you get to the end of the line and you sell a business and you see founders who have built their business the right way, treated their people the right way, to see them get rewarded for doing all those things along the way is, it's a really, really special feeling to be able to be part of that. And I'm not like, I think some venture funds get a little bit kind of high and mighty about changing the world and all that. Like that, we're selling protein bar and peanut butter and pet food. But seeing these people really have these kind of life-changing outcomes is pretty cool.
Yeah, that's and especially I would imagine where they trusted you with their baby, and so sort of making good on that. And I also think, what's so incredible about founders, especially of the products that you tend to invest in, is just the acute knowledge of their customer. And like that is such an impressive thing. And I think to your point, one of the things that I've heard so often is just their need to focus. Like, yes, we could serve every single consumer in the US and abroad, blah, 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 but like this is a customer that I'm serving, and I'm listening to him or her, and I'm serving him or her. And that really, is where I historically have seen success.
Totally. Yeah. And that ability to connect with that, like Ghost, going back to that example, is like Dan and Ryan, the founders, like a big part of their early marketing was like this YouTube series of them just like filming themselves, like doing their driver test, getting an apartment. And it was like this like kind of mundane stuff if you just put it on paper. And like anyone would look at that and be like, no one's going to watch that. That's not that doesn't make any sense. And like, it was awesome, right? And people loved it, and it was so authentic, and it was so true to them and just the way that they think about running a business and building a brand. And so that insight and that courage, again, to go do that when everyone else is going to tell them, no, go run your traditional playbook is really cool.
And I won't ask you what percentage of the views were from you. Okay, this is just. Well, McConnell, it was a treat, as always, to catch up with you today. Thank you so much for taking time out of this is a Monday morning, so thanks for taking time out of your Monday to connect with us.
No, of course. I always love catching up. You've been awesome, and happy to do it. So thanks for having me.
Wonderful. All right, until next time.
Thanks.